Hi, welcome back again. As promised last time, I am here to provide some additional information on this approach based on trading without charts. So I'm going to explain some of the elements that are related to this approach, not all of them, because otherwise the video will become incredibly long, but just anticipating, during this video I will provide the basic mechanism, but there are a lot of other things that are very important to ensure that this approach actually works. Okay, so what you see is just the basic and nothing else. So let's start with the first part, which is the rationale behind this approach. So why not charts? And what was the problem for me with charts? Charts are based on the assumption that prices can be predicted. And my conclusion on that one is that that assumption is rarely correct in the short term. So everything that is shorter than, I would say, at least 1 year, the predicting abilities of charts and indicator, in my opinion, is quite low. Prices, for me, are mostly changing in a random fashion. So all this predictive ability of technical analysis and charts and indicators, I can't confirm that it is there to a sufficient amount of reliability. I also tested it many times. I was literally taking snapshots of graphics, of charts, and I was looking the charts, the same chart, a few days back, and discovered many times that indicators which would have told me to buy something, say on day 1, when the chart goes to day 3, the indicator is not there anymore. It has been repainted, it changed its mind. So it was a false signal, but that false signal, if I followed it, as I did at the beginning, was going to cause me a loss. And that was obviously together with the famous stop loss concept, which I already described last time, I think. So I tend to believe that if there is a theory that is explaining rationally and can be somehow demonstrated to a certain extent how prices develop, that would be the random walk theory, which you can search it up, and which basically say what I just said. So prices are mostly moving in a random fashion. Predicting them is very, very difficult. So that was the first aspect. The second aspect, which eventually led me to decide to abandon charts and technical analysis altogether, is that since I was mostly interested in companies anyway, I like to buy, trade companies, most of the times companies, good companies, do not go bankrupt. So from an investing viewpoint, buying something that doesn't go bankrupt is a way to retain the value of my investing, of my money, basically. And similarly, I also observe that good companies tend to increase in share price. Okay, so the whole point of treating the buying and selling of these companies based on charts, considering the fact that the share price is going to go up anyway, most probably in the future, was again not particularly convincing. And I started to question whether this very short approach I was led into by using charts was justified. What happens if I buy a company and keep it for 3 months? Nothing. I mean, it is not a problem as such, but by using charts, that would have probably been presented to me as a problem, because during those 3 months I could have had a number of signals telling me to sell that company. And because sometimes often the sell signal is at a lower price than the buy signal, I would have ended up losing money consistently, which was definitely not the plan. Okay? So the time factor, how long would I stay holding a certain position, started to become a non-issue. I will hold the position as long as it takes, holding a position in a company I like, and just waiting. I told you about this in a recent past, but I want to stress this method because people are, in general, always in a rush of doing something. And sometimes they don't realize that doing absolutely nothing works way better. It's a bit of a farmer's approach, right? You put down the seeds and then you wait. You wait that the plants are starting to grow, and you wait that the plants are ready to be harvested. And when it is time to harvest them, you harvest them. It's a farmer's, let's say, normal cycle of life. You do something, you wait, and you do something else when the time comes. And I wanted really to use a similar approach in trading, figuring out a different way of trading. So the trade plan that I was practically grown up with was based on indicator. If an indicator say buy, I buy. When indicator say sell, I sell. Now that was not working well for me. Too many false positives, too much money lost, too many trades unprofitable. It wasn't working, right? And I was listening to the famous investors I already spoke about, the Warren Buffetts of this world. And as long as I can see, their conversations are never rotating around charting. They touch upon them sometimes, but it is clearly not their main tool. Their main tool is different. So they were having a different trading plan than looking at charts. And I was wondering, not being a billionaire like Warren Buffett, if there was something that I could imagine doing that was not based on charts and could have actually made money, right, consistently. So the trade plan, if something happens, then I will do something like that, was really the big question. How could I replace indicators with something else? What I wanted to get out of all this was quite simple, and I already told you what it is. For me, trading means making money. I'm not a collection item specialist. I don't buy companies for the sake of it. I buy company for the purpose of selling them for a better price and making money in the process. Or in alternative, to receive dividends for holding them. Okay, so that's the whole point. And I want to have some consistency in terms of profits, because the pure dividend approach, for instance, would have caused me to get a boatload of money once or twice per year, whereby I would like to have a cash flow that is much more consistent than once or twice per year. That would be very difficult for me to manage. I prefer to have small gains every day, ideally, instead of having these big peaks in money coming in at a certain specific times decided not by myself but by the company, because the company decide if and when they would pay a dividend, right? And then, of course, there was the absolute must requirement to absolutely avoid losing money. And it goes back to the time I stay into the market the avoidance of timing the market, trying to figure out what the future will bring, and avoiding absolutely to have unprofitable trades, which means losing money, buying high and selling lower, right? That was the whole point. And I think I found it. I think I found a system that it works. I know for sure it works because I'm keeping track of the profits I'm making, and these are profits, are not losses. And I'm going to explain you how it looks like, basically. All right, let's go. So what are the basic elements that are really supporting this trading approach? I listed 10 of them on the slides, but there are many more. So this is really the basic ones. And there are a number of them which are also incredibly important. So we will discuss them in a different moment. But for the time being, let's start with the first one, fundamental analysis. I'm a stock picker, okay? I trade companies that I select myself, that I understand as far as a company can be understood from being outside of it, on base of financial data. So that means that I do create, with time, my own so-called index fund, or a fund which contains only the companies I like, and for reasons that I know, and according to, I don't think it is a science, but it is making sense to buy a company, for instance, that makes money, that doesn't have much debt, that produce something I understand and like, and I have no problem in keeping for an extended period of time. So, know what you're buying. I think I know what I'm buying. And that comes from fundamental analysis. It's boring for many people, but I like actually learn what companies are making. I like to understand what kind of financial situation they're in. And I like to do that because once I find the company I like, I would like to buy a part of it. I also buy only shares of company, pure vanilla shares, and nothing else, particularly no derivatives. I don't trade options, I don't trade futures, I don't trade any instrument other than pure shares. For what reason? Well, first of all, because I understand shares. I mean, it's one to one, very simple. You buy one share of company, whatever, and that's it. That's everything there is to it. The share will not change in the future. It is not something that is going to become something different. It is a share of a company, it's a part of the company. That's what I'm buying. When it comes to derivatives, so-called options, futures, and many other things, basically the same, contract for difference, CFDs, another beautiful example. These are not shares of companies. These are contracts, okay, related to, in some cases, not in all, shares of companies. They could be related to commodities like oil, like gold, and all this kind of other things, which I'm not interested in at all. But the point is they are contracts, and these contracts have a certain expiry date. Shares do not have an expiry date. Okay, so because my trading approach is based on a potentially long waiting period, I never know from the beginning. I don't know if and when a certain transaction will be sold in the future, but could take a considerable amount of time. For me, trading contracts which basically die after some time was definitely not interesting. Something that would defeat the purpose of the whole trading mechanism that I use, right? So I don't do that. Pure vanilla shares of company. I also don't do something that a lot of people do, which is I don't do shorts. I only do long positions. For those who don't know, buying something, like buying a piece of bread, yeah, represents a long position. You start with money, and you transform money into something, like the share of a company, for instance, so you trade money for something else. Going short means to sell something that a person does not have. So you basically say, I will sell you that piece of bread today, getting the money and hoping that that piece of bread will decrease in price tomorrow so that you can buy it back, so to say, closing the short position. And the reason why I don't use short positions is that, in my experience, they tend to lose a very large amount of money. The very fact that they have normally an expiry date means that the outcome I'm interested in, which is buying and selling at a higher price, needs to happen in a specific amount of time. If that happens too late, I lose the investment I made, and I don't want to have that. Okay? So no shorts, only longs. You only buy and you sell what you bought before. Pure vanilla, extremely simple. The other elements of this approach, which is very, very important, is that it is not meant to build a position. Now, some of you might be familiar with the so-called dollar cost averaging. Dollar cost averaging means that a person would buy at regular intervals in time a certain specific amount of money worth of a certain asset. Okay, so let's imagine company whatever trades at 10 initially. I buy 10 shares of company whatever on every first day of the month, irrespectively of the price. Now, apart from other discussions related to this approach, I don't want to get in there now, but the dollar cost averaging, first of all, is based on buying only and never selling. So it is really meant to build a position, all right? Because this trading approach includes both the buying and the selling side, it is not meant to create a position. It is transactional in nature, all right? So buying and selling means also that each transaction, the buy transaction, must be sufficiently small to avoid actually building a position. So to give you an example, if you have 1,000 euros and you invest 1,000 euros in the shares or whatever on day one, from that moment on, the cash is gone. There is no more cash available. So it is a position and all your money are in there. This is a lump sum. With this approach I'm using, the requirement is that having 1,000 euros in cash means that I would buy maybe 100 euros of company whatever today, and no more than that. Next time I would be interested in buying again company whatever, I would also invest no more than 100 euros. Okay, I will explain you later how that works and why it's there, but position sizing is, transaction sizing is very, very important. It is not meant and doesn't need to build a position. This approach is also obviously reactive in the sense it doesn't predict anything like charts try to do, like technical indicators try to do. I don't try to do that. For what I'm concerned, that's a rather useless exercise. It doesn't tend to work very well. And quite frankly, why should I predict something if I have a much easier life in defining what I will do if something happens? I react to events. I don't anticipate them. I just decide that if something happens, I will do something. If something else happens, I will do something else. All right. So I have a so-called trade plan, which is also extremely simple. I can explain it to a 10 years old person, and that person will probably understand it. And especially I need to understand it, and I need to make sure it is actually working. And it does. It does. So as we said before, it is a process of buying and selling, right? Now, the selling side is automated. Why? Well, because suppose I want to make 10% of each transaction I have collected and performed in the past. So I have a transaction that I opened at 10, and by the time the shares reach 11, that's 10%, and I sell it. I don't need to think about it, right? There is no second guessing in the selling approach. So those are automated, and are automated with good till cancelled orders issued to my broker, as I think I already explained you last time. So that's easy. The buy side is different, because the buy side means that I'm buying something that saw the share price decreasing, right? Because I buy when the share price goes down, not when the share price goes up. I buy a falling knife, what people call a falling knife. But every time I see that one of the companies I'm interested in is decreasing in price, before I buy it, I need to understand why that price has decreased. If there is something about the company, if there are problems with that company, if the company is not something I would like to buy, I need to know before I actually pull the trigger and invest my money in that company. So it's manual, and it is manual because every time I need to, I think about investing money in a company, I want to study what is the situation of that company. And I do it every single time before opening a buy transaction, right? Every single time, no exceptions. So it cannot be automated, basically, that's the point. I thought about automating also the buy side, but I always decide against it, because buying something that decreases in price but remains good, it's okay. I can easily live with that. But buying something because it decreases in price, because the company is going to go bankrupt within a month, is stupid, in my opinion. So I don't do that. All right, so that's easy. As anticipated last time as well, the whole point of this trading approach is creating profits out of trades, buy and sell at a higher price, and dividends. Dividends are a very important part of this trading approach. Because it is not based on indicators, and because prices can stay unchanged for a very considerable long amount of time, months, okay, I buy something at 10, and that something at 10 stays at 10 or thereabouts for 6 months. A part of my money is in that transaction, and if that transaction doesn't produce any money, because I don't trade it, it's basically frozen, right? I don't want to freeze or invest my money for something that doesn't pay me in some way. So the dividend approach is great because you are basically paid for holding something for a certain period of time. And since sometimes I cannot trade what I have for sometimes, I can get dividends while waiting. So dividends are the plan B. The plan A is hopefully to be able to buy something at 10 and sell it at 11 or whatever, 10%, what you want, as quickly as possible, really. Okay, having a fast turnover in the shares and in the companies I have. So two plans. Trading, if trading doesn't take place, getting dividends. Now, I told you in the beginning, I think it was point 4, there is no intention of building positions here. In fact, building a position is something that I really want to avoid. If I build a position on a certain company, this company goes bad, really bad, and it happens, then I lose my investment. So I keep my transactions as small as possible, but I also set a limit to the amount of money I will invest in any given company. So I have a maximum. I keep buying this company until I reach that level of invested money in that specific company, reach a maximum level which I decide. From that moment on, I stop increasing my position in that company, and I'll just wait that the price goes up sufficiently for the latest transaction I executed, buy transaction, to be closed successfully, selling the company for a profit. Okay, so there is a maximum level of investing per company. Because of its nature as a trading system that involves the continuous buying of companies when the price of the shares decrease, so buying discount, that means I need to have sufficient cash to be able to do that. If the share price of something goes down and I don't have cash to increase my position by buying again this company at a discount, the system doesn't work anymore. It becomes a lump sum approach. So you put all your money in a certain place and then you just wait forever until you can sell it. So having cash available for buy transactions is really important, which means that at any given moment in time, I will never be completely invested. I will always have some cash on the side. And how much cash on the side depends on the circumstances. Sometimes the markets are going up. I sell a lot of the stuff I have. My cash position increases, so I am sitting on a pile of cash. And I have few transactions still open. I have more cash than shares. Some other times, exactly the opposite happens. So I will keep buying companies because the markets are going down, so my pile of cash decreases, and the amount of shares I have increases. So it really depends a bit on how it works. But the basic principle is, if there is no cash available anymore, the system stops working. It's like feeding it, okay? If the food is finished, the money is finished, then the system stops working. It becomes no more a transactional trading approach as it is supposed to be. It becomes literally a buy and hold, because if I cannot sell the things I have and I don't generate cash, I don't have the cash to buy or to increase my positions anywhere else. Simple. And then again, because the system does exclude the possibility to sell at a loss, there is no stop losses. I don't use those in any way possible. They are just not in this approach. Excuse me. So as I think I told you last time as well, there are only two situations in which I would sell at a loss, right? Either I'm sure the company is going absolutely bust, all right? Or I need to sell it because of an acquisition from another company where the share price offered is lower than what I bought it at. Exceptions. This kind of things can happen, is a losing trade. It's always very annoying when that happens, but it's possible. So having cash available is also a way to compensate for it. Some trades are going nowhere, Very few are becoming losing trades. You have to get rid of it. But the cash available and the overall mechanism behind buying good companies, in general terms, works consistently and very effectively. So let's go further and let's see how this system works in practice. So let's talk about company whatever. After having studied it, I conclude that I like the company, I want to buy it, right? I've also decided, and this is pure imaginary, guys, this is just, an example. I could also have decided that I want to buy a company whatever in increments of 10%. So 10% is the level at which I would take action, either buy or sell. Okay, anything less than 10% change would not cause me to make a trade, make a transaction. And let's also imagine that the amount of money I want to use each and every transaction is limited to 100 euros each time. Okay. All right, so company whatever trades at a certain price, whatever price. I like the company as it is, and I buy it at A. I buy 100 euros worth of share of company, whatever, at point A. That is the first buy, right? Let's imagine that after I bought it, the shares of company whatever drop by 10%. 10% drop means that the company I bought initially and that I liked initially for 10% more price, right? Now it comes to a discount, 10% discount, same company I liked before. So what I need to do now that the share price dropped by 10% is deciding if I want to buy it again or not. So I need to study company whatever again and reevaluate if I want to buy additional shares of company whatever or not. I decide to buy more because company whatever didn't really change in this imaginary example, right? Cool, okay, so now I have 100 plus 100, I have two transactions on company whatever. One position is made by one or more transactions, but I have still one position in company whatever, worth 200 euros. Price keeps going down. This is not particularly nice, of course. I'm not particularly happy on one side because I would like actually to trade and make a profit on company whatever. But in this case, since the price is going down, I have again the same problem as I was having in B. Do I want to buy more company whatever? I look at it again. I decide I want to buy more shares of company whatever. Now I have 300 euros invested in this company. Okay. And I have three transactions, A, B, and C. A and B are losing money. C is at break-even level. Share price keeps dropping. Again, 10% off. Now we are in D. Do I buy more of this? I conclude I want to buy more of this. I buy additional shares, fourth transactions, 400 euros invested. I have 400 euros worth of company, whatever, in my portfolio. And out of the 4 transactions, 3 are losing money. Now let's stop here for a second. Most of people, when the share price starts to drop, they tend to sell their position, the whole position, okay? Because it is stop loss, it is a sell indicator on some chart, it is that they don't want to lose money, as they say, all these kind of things. For me, given the company being still what I studied and liked originally, for me, a drop in price is an opportunity to buy. When everybody sells, I buy. If, of course, the company is still good, right? This is a contrarian approach to investing, which is, by the way, one of the main messages coming from basically all great investors that I know. I saw and I read a lot about what the most famous investors have always been saying, and the message on this score is absolutely consistent. Buy when everybody is selling and sell when everybody is buying, right? So anyway, we are at D. Share price went down 30% versus A. I bought it consistently, and obviously, as you can imagine, I am not losing 30% on the whole position, because I am losing 30% versus A, 20% versus B, and 10% versus C. Okay, so my total loss, and the non-realized loss that I'm having, is not 30%, it's far less. Anyway, we're in D. Share price arrives at a certain level, and what normally happens is that when it arrives to a certain level which makes this company interesting for other people than myself, other people start buying it, which produces an increase in share price. So share price goes from the D level, minus 30% versus initial price, to minus 20%. It goes to E. In E, I have a very interesting situation, because the whole position is still losing money, right? But there is one transaction which I now can sell. In E, I can sell D at a profit of 10%, which I do, because now is the time for that position, for the transaction in D to be closed for a profit. It's fine. So in E, I am now having not 400 euros invested, but 300 euros invested. And I have 10 euros of profit, right? So we're in E. Share price keeps going up. I reach the minus 10% line. The minus 10% line means that now I can sell C, right? Because C was a minus 20%. Now we are at minus 10%. In F, I sell the transaction C. Now I have 200 euros invested. I made 20 euros of profit, 10%, two transactions, sorry. We're at F. Share price keeps going up and goes to G. G is the same price that I bought the company originally for. So the first transaction was exactly the same price in A, and now the share price went back exactly to that level. In G, I have one open position, which is B, which is now profitable, and I sell it. Now my investment in company, whatever, is limited to A, 100 euros. But I sold it, how many times? Let's see, 1, 2, 3 times, which means I made 30 euros of profit, while the share price went absolutely nowhere. That's one of the magic aspects of this trading approach. Irrespectively of the fact that share price is trending, trading, market is depressed or optimistic, it doesn't matter. The very fact that the share price changes up and down produce opportunities to buy and opportunities to sell for a profit each and every time. So this particular case explains the power of this approach. If I would have invested, as some suggest, 400 euros in this company initially at A instead of 100, and 400 euros were all the money I was having, I would have to wait until G before breaking even. I would have made no money whatsoever during all this time, And after so much time, I basically have the same money I was having before, right? Most people would have liquidated their positions before getting to G. They would have sold at B, they would have sold at C, and they would have sold at D, taking losses, stop losses, whatever. I don't do that. Now, since we are at it, let's imagine for a second that at D, while looking at this company again, I would conclude that this company is not as good as I thought it was. Okay, it started like a good company when it was at A, and this has nothing to do with the share price. Share price is irrelevant. Something happened to this company where their numbers, I don't like them anymore, right? So in D, if I study this company and decide I don't want to increase my investing in this company, I would just not buying it anymore, right? So when it would reach D, asking the question, do I want to add additional shares to the company? The answers could have been no, I don't want to. This does not mean that I sell A, B, and C at a loss. You know what I do? Absolutely nothing. I leave those transactions open because I don't sell at a loss, and secondly, because this transaction A, B, and C are in company whatever. I picked company whatever for a number of reasons. One of them being the fact that this company pays dividends. So, unless the company goes completely bust, between the price reached at D and the time where one of the remaining transactions, A, B, and C, could be sold, I will get dividends out of this company. I'll make money anyway, right? But this is not the case. So let's go back to D. So E, F, G. So we sell transaction by transaction on the way up. We're at G. Now, what happens is imaginary, of course, that the share price drops suddenly from G to H, which is a 20% drop. It happens most of the times, in my observation, is an analyst downgrade. Somebody expresses a negative opinion on the company, an article on a newspaper, whatever, this kind of stuff. The reason why people decide to dump a company based on somebody else's opinion, often enough without looking at the numbers themselves, is for me a mistake. I will never understand it. But these kind of things happen, there are rumors, there are opinions, there are forecasts, predictions, a lot of noise, really. But that noise translates in the fact that, for what I'm concerned, this company is now trading again at 20% discount this time versus the only transaction still open, which was A, right? So it drops to H, I buy it again, keeps dropping, goes to I buy it again. Now I have again 3 transactions if I counted right. And it goes back to D, to the same level it was D, right? Which is fine, as you can see, is a kind of trading approach, this one. It's a trading movement between the 0% and the minus 30% line, and it keeps going up and down between those prices. I buy again in I. Now, when it was in D, it went to E with a 10% increase, so rather slow. In this case, it reaches I, and imaginary, the price jumps again, and it goes to L. This time, it jumps by 20%, not 10%, but 20%. And I need to change this slide because it is incorrect. When it jumps to L, I have 2 trades that now can be sold for a profit. 2, not 1, 2, which is I. I can sell I for a 20% profit, and H is still open, and that can be sold for a 10% profit. I sell 2 transactions in the same moment for the same level of profit, for a different level of profit, 10%, which is my minimum for H, and I for 20% profit, which is quite good. So, until I sell those 2 transactions, share price keeps jumping again. It goes to M. At M, something funny happens, because it happens to be 10% above my first trade, which is A. Now I can sell that too. It is, by the way, my oldest trade. So I sell A for a 10% profit. And now I have no shares anymore of company whatever, because I sold everything, right? I bought on the way down. When it was up, when it was going up, I was selling what I was buying before, and I did it several times, and eventually I sold all the transactions I was having, including the first one, the oldest one. All right. So now I am without any shares of company whatever, and what do? I look at company whatever again. I see if I'm interested in buying it, even if the price is now above what I bought it for sometime before. I decide I want to buy again company whatever, and that's what I do. I just buy 100 euros worth of share of company whatever at N, just like I did it at A. Exactly the same story. This approach is very, very powerful. It can be used in, I think, many, many situations, as long as there is a basic assumption that the asset I buy is at least supposed to go up in share price sometime, right? And it is really a derivation of time. The longer I wait, the better it is. I cash in dividends anyway, assuming the company keeps giving dividends, which is sometimes the stop to dividends sometimes cause the share price to drop, by the way. So, okay, that can happen. And in this mechanism, there is no space for selling at a loss. It's simply not there. And that's a big difference with the technical approach, because the technical approach includes a buy and sell mechanism, but the sell mechanism sometimes often occurs when the sell price is below the price that was paid when a buy signal was given. So you buy at 10, the indicator says buy at 10, because the indicator thinks that the price will go to 11, but the price drops to 9. And at 9, the indicator says sell. And when you sell at 9, you lose 10% of that trade. In this system, this is not existing. There is no mechanism that causes a losing trade. You never sell at a loss, according to this approach. All right? Cool. So, as anticipated at the beginning, be mindful of the fact that this whole system works only when there are a number of other things in place. Okay? Like this, it can sound interesting, but there are really important elements that allow this system to work properly. Just to mention a few, we need a tracking system worth this name, because without a tracking system, it is very easy to make stupid mistakes. We need to talk about costs, very important aspect. Now we are imagining that none of this costs anything, but costs are relevant and they are important. We need to talk about money management, because these 100 euros, 400 euros are extremely important in terms of deciding how much money a transaction may be worth at max. And we need to talk about, let me see, I was having another one in mind. I don't remember now, but we need to talk about other things. And without these elements, this system could malfunction and malfunction really badly. So I will slowly but surely expand on this idea. Together with you, I will share you what I'm using. And well, that's more or less it for the moment. I thank you for your time and your attention, and I wish you a fantastic day. Subscribe if you want to get news when a new video is posted. Click on the like button if you like this video. Leave a comment if you feel like. Always interested to learn from other people what their experience are and what they think. There is always something to learn from me, so please feel free. I wish you a great day, and until next time, bye now.